Hello and welcome to Energy Insights. Today we are looking to the latest developments in the energy sector across the globe. Particularly, we will be looking towards the European side, United States, and overall the market overview for the crude, for LNG, gas, and the refined products. So, starting from the segment one, where we have to look into the gasoline margin surge and the electric vehicle demand acceleration in Europe. This we will cover in segment 1 today. The European oil refiners are currently benefiting from the historic surge in the gasoline margins, with the refining cracks registering their largest weekly increase on record. This sharp upswing reflects a significant widening between the crude oil input costs and the gasoline prices, allowing refiners to capture higher returns per barrel. The improvement is largely driven by the tight gasoline supply conditions, unplanned refinery outages, and maintenance shutdowns across parts of Europe and Atlantic basin, all of which have constrained output at a time when the seasonal demand is beginning to strengthen. Compounding this trend is a broader geopolitical shock to the global oil markets, which has pushed gasoline and diesel prices sharply higher across Europe. So, supply disruptions and heightened risk premiums in the crude oil trade have translated into a rapid increase in the retail fuel prices, placing direct pressure on the consumer and businesses alike. In many European markets, the fuel prices have risen within the short span, amplifying concerns over affordability and energy security. One of the most notable consequences of this price surge has been significant behavior shift towards the electric vehicles. Electric vehicle sales across Europe surged by approximately 51%, indicating a strong consumer response to elevated fuel costs as gasoline, petrol, and diesel become more expensive. So the total cost of ownership for the internal combustion engine vehicles increases, making electric vehicles comparatively more attractive due to the lower running and maintenance costs. This trend is further supported by existing policy incentives, expanding charging infrastructure, and growing consumer awareness around sustainability. From market perspective, this creates a complex and somewhat contradictory outlook for refiners. So, short-term upside is that the refiners are enjoying exceptionally strong margins, improved cash flows, and better utilization rates as product prices outpace the crude costs. This puts and also provides a temporary financial relief after periods of margin compression and operational challenges for the refiners. While from medium to long-term downside risk is also there, persisting a high fuel prices risk triggering demand destruction, particularly in the transport sector. This rapid acceleration in electric vehicle adoption suggests that the consumers are not only reacting to the short-term price spikes, but also the structure is shifting away from the gasoline or petrol dependent mobility. This interplay highlights a broader transformation underway in the energy sector. Price volatility in the fossil fuels is increasingly acting as a catalyst for the energy transition, accelerating the shift toward electrification and alternate energy resources. What was once a gradual transition is now being reinforced by the real-time market signals and economic pressures. So this concludes our today's session 1. However, in essence, the current environmental presents a paradox for the refining industry. While elevated gasoline prices are driving record profitability today, they are simultaneously underpinning the long-term demand outlook for a refined petroleum products. Overall, the surge in the gasoline margins underscores tight supply fundamentals and the geopolitical uncertainty, but the parallel rise in the electric vehicle adoption signals a structural shift in Europe's energy consumption patterns, which could reshape the future trajectory for the refining and the fuel markets. From the segment 1, now we have to dive into the segment 2, which is the US push to secure rare earth supply chains outside Asia. The United States is intensifying efforts to reduce the dependency on China for critical minerals, with the major strategic move centered around the acquisition of Brazil Serra Verde rare earth projects. So the development highlights a broader geopolitical and economic shift with rare earth supply chains are becoming key battleground for technological and energy security. At the core of this move is the recognition that Asia currently dominates the global rare earth industry, controlling more than 80% of the processing capacity, which gives it significant influence over pricing and supply. So these materials such as neodymium, dysprosium and terbium are essential for manufacturing electric vehicles, wind turbines, defense systems and advanced electronics, making them critical for both the energy transition and national security. So the Serra Verde mine in Brazil is particularly important because it is the only operation outside Asia capable of producing all key magnetic rare earth elements at scale. This makes it a strategic asset in the West's effort to build an independent supply chain. The acquisition by a US firm is part of the broader mine to magnet strategy aiming to control the entire value chain from extraction to processing and final magnet production. In addition, strong backing from the US government, including the billions in financing and long-term supply agreements, demonstrates how seriously Western economies are treating this issue. These measures are signal to de-risk investments, stabilize prices, and ensure a reliable supply, especially in the face of expected shortages of rare earth elements in the upcoming year. Overall, this development signals the structural shift in the global resource geopolitics, where countries are actively diversifying supply chains away from the Asia. While the transition will take time due to the technical and financial challenges, the Serra Verde deal represents a major step toward reshaping the global rare earth market and strengthening the Western industrial reliance. So this concludes our segment 2, and now we have to look into the market, the energy markets as of today updates. So global energy market analysis we will cover in the segment 3, where the crude strength, product tightness and the gas LNG divergence we will briefly discuss. Global energy markets are showing a broad upward rally in the crude benchmark, supported by the geopolitical risk premiums, tightening supply conditions and strong downstream product demand. However, the market remains structurally uneven across the crude, refined products, natural gas and LNG. The Brent crude price remained $95.50 per barrel today, which showed an upward movement of 5.66%. WTI crude traded at $88.64 per barrel, which also showed an upward movement of 5.71%. Marban crude traded at $91.58 per barrel, which remained a little bit stable, minus 0.13% downside moment. OPEC basket remained traded at $99.60 per barrel, which also showed a downward moment in comparison of yesterday price. There's trans percentage is 4.95%. Crude markets are broadly bullish, led by the Brent and WTI strengthen, reflecting tight prompt supply and elevated geopolitical risk premiums. However, the OPEC basket is under pressure, signaling weakness in the medium sour grade crude pricing and shifting refinery preference toward the lighter crude grades. In case of refined products, the gasoline traded at $3.11 per gallon, which showed an upward movement 3.73%. Diesel also showed an increase of 4.65% and traded at $3.55 per gallon. Similarly, the jet fuel traded at $3.55 per barrel, which also an upward movement of 4.65%. The refined products complex is showing a strong synchronized gains driven by tightening inventories and resilient end user demand. Gasoline strength reflects transport fuel demand and seasonal consumption increases. Diesel gain highlights industrial, freight and logistical demand resilience. Jet fuel mirrors a steady aviation recovery trend globally. Together, these movements confirm a robust refining margin environment with strong crack spread across the barrel. In case of natural gas, the Henry Hub price remained $2.07 per MMBTU, which an upward increase of 1.05%. The US natural gas prices remain relatively stable, supported by balanced supply-demand fundamental and moderate demand growth. Compared to oil volatility, Henry Hub reflects a more anchored and range-bound market structure. While in case of the LNG market, Regional divergence between the Europe and Asia highlights that the TTF traded at $13.44 per barrel. Similarly, the Asian benchmark, the JKM, traded at $19.20 per MMBTU, which almost remained the same as of yesterday. So the LNG market continues to show a clear regional divergence. Europe TTF is weakening due to easing supply stress and improved storage conditions. Asia remains stable, reflecting steady import demand and balanced LNG fundamental that's been highlighted by the JKM. The divergence highlights a rebalancing global LNG flows with Europe normalizing while the Asia maintains a structured demand stability. Overall, the global energy market is currently defined by three key dynamics. The strong crude oil rally led by the Brent and WTI, robust refined products pricing across gasoline, diesel and jet fuel, and diverging gas and LNG markets with Henry Hub stable. TTF is weakening and the Asian GKM is steady. Overall, the markets are in phase of crude-led strength and product-driven margin expansion, while the gas and LNG segments show regional imbalance and normalization trends, particularly in Europe. So this concludes our today's analysis. If you found this analysis helpful, please subscribe and hit the like button, and we will see you in the very next episode with more updates and more analysis on the energy side. Thank you for watching Energy Insight.